Hi, this is Peter Dorman. Today's lecture is about the rise of a sector of giant firms within the capitalist economy alongside a sector of small firms and how this has changed the nature of the system. We have a number of questions that are useful to ask about firms in general, and big corporations in particular. First of all, we'll start out with what a firm is, of course, and why firms exist, how they are run and organized, the economics or economic theories that have been thrown around to try to figure out why firms operate the way they do. We will get to the system level a bit to consider how corporate capitalism of today is different from the capitalism of the 19th century. We'll spend a little bit of time on the position of small business within a capitalism dominated by big corporations, and take up a couple of topics that are very interesting in contemporary changes in corporations, specifically the rise of new production networks and also what is often called the financialization of the corporate realm. So let's begin. What's a firm? Well, legally a firm is an entity which holds capital. It's a possessor of capital or an owner of capital, and it's separate in a legal sense from the individuals who may own the firm or who run the firm or work in the firm or have any other relationship to it. So if we take that apart, if we consider the separate part, what the separate part really means is that the firm is like an object. It's like a car, for instance. I have a car, I could sell the car, you could buy the car, and it's the same car, but it's passing from one person to another because it's an independent thing. It's not an outgrowth of me. Well, the firm is operates the same way. You can buy and sell firms, and that opens up the possibility of limited liability, which we'll get to shortly. To say that it's a holder of capital is to say that what the firm is what it owns. It is an entity which owns assets, and so that ownership of assets is the entity. Now, what's important about that is that the firm is separate from the things that it produces, and it's also separate from the people who happen to work in it at any point in time. In fact, a firm could completely change its method of operations, what it produces, the markets it sells in, its physical location, its employees, its managers. Everything about a firm could change, but legally it would remain the same firm as long as the firm had not been dissolved or its entity had in other ways been modified. There are various types of firms. This is just a very basic type of delineation. First of all, we can distinguish between public and private enterprise, where public enterprise would refer to firms owned by the government or different levels of government, anywhere from the city up to the federal government, and private enterprise is everything else. So it's firms that are owned outside of government. It could be by private individuals. It could be, as we'll see, a cooperative, any other type of firm. There's a trick with the word public, which we'll get to shortly. We can distinguish between for-profit and not-for-profit enterprise. So legally, some firms are classified as for-profit, which means that if the people running that firm make decisions which can clearly be shown to not be motivated by the desire to make profits, they could be brought to court. They could be sued for violation of their responsibilities. And then we have nonprofits, the nonprofit world, where legally the enterprises are for purposes completely other than profit. And now we have a third sphere, the for-benefit or the social purpose corporation, which is partly for profit, but partly for other purposes as well. Another distinction, proprietorships, partnerships, corporations. A proprietorship is owned by a single individual. A partnership is owned by a named group of individuals. So a law firm, for instance, which might be a partnership, is owned by the partners of that law firm, and they're specified by name legally, and you have to go through a legal process to change the partners. Finally, you have a corporation which is completely separate from its owners at any point in time. In corporations, typically you have some kind of a wall between the legal entity of the firm and the ownership. In particular, that can take the form of limited liability, so that if the firm, the corporation, becomes liable for serious obligations, those obligations cannot be passed along to the owners of that corporation. It doesn't go through the wall, so to speak. Corporations are often organized on a shareholder basis, meaning that in theory, pieces of the corporation are sold as shares. Individuals can buy and sell them. And there we distinguish between two types of corporations, of shareholder corporations, those that are publicly traded, so their shares are traded on the stock exchange. Anybody is legally able to buy a share of them, versus privately held corporations, which are not traded publicly and only designated individuals or people belonging to a certain category are allowed to hold those shares, like a family, for instance. So you will sometimes hear the word public used to refer to publicly traded corporations, which are nevertheless private corporations. I apologize for the confusion of language, but it happens. Cooperatives can take one of three forms: worker cooperatives, consumer cooperatives, or supplier cooperatives. A worker cooperative is run on the basis of one worker, one vote for major policies, board of directors, etc. Consumer cooperative is one customer, one consumer of that enterprise, one vote for such major decisions. And a supplier cooperative is one supplier, one vote. Traditionally, supplier cooperatives have been very important in agriculture, where growers have come together for marketing and processing and things like that. We are now seeing perhaps the beginning of hybrid cooperative forms that are combining elements of worker, consumer, and supplier management. So limited liability, we'll come back to that for just a moment. The concept of it is how much, really, it raises the question of how much the owner of a share of stock in a company should be liable for. So recently there were wildfires in California that caused vast amounts of damage and loss of life. Those wildfires, in part, can be traced to the sparks given off by the power lines of Pacific Gas and Electric, PG&E. PG&E was facing potentially very large liability settlements in the courtroom, and so it has chosen to go bankrupt rather than face that. In the event of this bankruptcy, none of the owners, such as they are of PG&E, the shareholders, are responsible for any of those obligations. So those obligations simply are unenforceable on anyone. That's the whole idea of limited liability. So if you're invested in a limited liability corporation to the tune of $100, that's all you're liable for. The reason this has emerged is that it encourages people to make large investments that they otherwise wouldn't make. And it also encourages a large stock market of relatively easy buying and selling of shares. People don't have to worry about if they buy a share of stock, does it mean that they're going to go bankrupt because of some hidden liability that they didn't know about. It makes it much easier to run a big corporation in a stock market. Governments everywhere around the world have created limited liability in one form or another for these reasons. However, it's important to remember that it creates unbalanced incentives for a firm, so that the shareholders of the firm have no limit to the amount of profit that they can take in, but they are limited to the amount of losses they can undergo if they invest in a firm. And that can be a very serious problem in environmental areas in terms of how banks operate and so on. That's a more detailed topic we won't get into. The standard model of corporate governance has the shareholders on top. So whoever happens at a given moment in time to hold a share of stock is a shareholder, And they exercise their control not on the basis of one person, one vote, but one share, one vote. So you might have a share in a large corporation, but if it's only one share and the corporation has billions of shares out on the market, your vote is relatively meaningless, but it's not zero. In theory, the shareholders control or elect the board of directors of the corporation. In fact, there are lots of regulations that limit and manage in different ways how shareholders can do that. And most observers think there's fairly attenuated control on the part of shareholders over boards of directors. The board of directors meets a few times a year, and it has authority over the top management of the firm. So the top management team, which includes the CEO and the chief financial officer, chief information officer, other high-level officials and their staffs, have a central office which is, in theory, managing the firm. Beneath them is the operational management, and the operational management is in charge of the day-to-day functions of the firm. It's more dispersed. It's typically located where the operations of the firm are and not in a central office. And then finally on the bottom, you have the non-managerial workforce, which takes orders, in theory, from the managers above them, and in that sense, they're at the bottom end of a long chain of control that begins with the shareholders and ends with the workers. In reality, it's much, much more complicated than this, but this is the standard image of how a corporation is supposed to be run according to the law and according to popular understanding in the media. Now, as I mentioned just a moment ago, shareholder control was very attenuated. And still is in many ways by law. By attenuated, I mean it's not robust, it's not strong, it's stretched out and has a lot of limitations to it. The shareholder value revolution, which took off in the 1970s and 1980s, was intended to change that and to put shareholders in the driver's seat. Now, to understand the shareholder revolution, it's important to understand what it was revolting against, and that is the stakeholder version or view of management of the firm. So the idea of the stakeholder view is that there are many groups in society that have an interest in the performance of the firm. Certainly its owners, but also its workforce, the larger community, government institutions, you could draw up a list. And so the job of the CEO was to balance those interests in certain ways. In practice, they were often balanced in the direction of profits, but there was some consideration given to nonprofit motives for operating the firm. The shareholders, on the other hand, are people who have bought shares of stock typically for just one reason, which is to make money off of it. So in theory, their only interest is profit. Therefore, a shareholder revolution is a revolution against the idea of social purposes for a corporation and for the idea of profit and profit only. The fear that underlay this revolution at the time was that managers were too independent and that they were often making decisions for firms which maybe verbally sounded like they were for the stakeholders, but really the managers were just feathering their own nest. They were just making an easy life for themselves, building their little empires, and not accountable to anybody else. So the idea of accountability was accountability to shareholders. Two methods were introduced in order to assert this accountability, both of which required action by the government to change regulations about how firms and stock markets and so on were managed. The first is what was called the market for corporate control. So the idea then is that groups of shareholders could compete with each other to buy a controlling interest in a firm and then do whatever they want with it. And the competition between those groups of shareholders would force managers to put profits at the front in order to reduce the likelihood that there would be a takeover and they would be sacked. In order for that to happen, the various defenses against takeovers, which existed in the law, had to be taken away, and governments had to agree to do that. The second thing is to tie the manager's pay, the top managers pay to the share price, to the stock price. So pay was less in the form of salary and more in the form of bonuses based on how high the stock price went up. And that change has been quite dramatic and is a major factor in the rise of very, very high compensation for top managers in the corporate world. As we'll see, these changes had an enormous effect on how firms operated, and in some sense, even on the nature of the system overall. Before we get into that, though, it's useful to back up and ask some very fundamental questions. Why are there firms at all? Why do firms exist? We recall that a firm, to be a firm, has to be a separate entity in some way. And so to be a separate entity means that it has to do something. There has to be some operation or function of the firm. Firms can outsource things, but they can't outsource everything. If absolutely every function of the firm were outsourced, it wouldn't be a firm. So there's in-house and there's also outsource. But now, when you think about it, to produce something within a firm is to forego the opportunity to outsource it. And so then you may ask, why would anybody do that? Why would you produce something internally if you could buy it from somebody else? After all, out there in the world, there are many people, perhaps, who could produce what you are producing internally, and they might be able to do it better or cheaper than you do. So why not just outsource as much as possible and only do a tiny number of things that nobody else is doing inside your firm? This is the kind of ruling question that economists ask themselves when they think about why there are firms and what's the theory of the firm and how do we model a firm and so on. This is not, as you can see, a binary decision. It's not that the firm does everything or does nothing. Rather, it's about the boundaries of the firm, or to put it in the usual terms, the make or buy decision. So why are the boundaries where they are? One useful way of thinking about boundaries is this diagram, which you may remember from the textbook. Lots of little stars and arrows. So what the stars represent are activities. And what you have is a big field of activities, different things that are being done. The activity could be hammering one piece of metal to another, or the activity could be meeting with a client to take in information about the client's needs, or something. It's an activity. The arrow is a relationship between that activity and some other activity that is conjoined to it logically as part of some larger set of operations. So if, for instance, you're in a law firm, there's a first activity which involves sitting down with the client and finding out what the client needs. There's another activity which is perhaps identifying what branches of the law that need pertains to and doing research on those branches of the law. There may be other activities involved in filing different types of papers or whatnot. So there are a number of different activities, and they're related. They're not freestanding. And the arrows refer to the relations between those activities. So what the diagram is telling you is that some arrows occur within these blobs, within these walls. And those activities that occur within walls are in a firm. And so the arrows are within the firm. They are therefore organized and managed by the management of the firm. Whereas other arrows go between walls. They go across walls to other blobs. That's the market. So that's involved in buying and selling the output of different activities to other firms that might use them as part of some larger operation. The theory of the firm is why these blobs exist and why some blobs are bigger and some blobs are smaller, what the explanation is for historical trends in the rise or non-rise of large blobs, large firms. This is what economists are interested in. Broadly speaking, there are three kinds of theories about why these firms exist and how they exist. These are very simplified versions of these theories I'm about to present. The original theory, which dates back to Adam Smith in the 18th century, is economies of scale. So it's simply about cheapness in some sense. If you bring the activities together under one roof, under one management, you can do them, you can break them apart into their component activities more finely and through supervision. and then and recombine them through supervision, and you find this is typically much cheaper. So this is the story of Adam Smith's pin factory, which is worth reading if you've never looked at it. Another great economist about 100 years later who developed that idea was Alfred Marshall. And he did quite a bit of empirical research going around to firms and observing how they made decisions and what costs were on their books and so on. Now the problem with this theory is that if you actually look in the real world today, a lot of the decisions firms make are not explained by this. After all, if this theory were correct, we would expect firms just to get bigger and bigger and bigger, but they don't. And in fact, many firms choose not to get bigger or even to get smaller. So we need a much more finely differentiated theory to help us understand what's going on. The second theory, transaction cost, originated with Ronald Coase, a Nobel Prize-winning legal scholar and economist, and his, I won't say his student because they didn't study together, but his follower, if you will, Oliver Williamson, who took Coase's ideas and ran with them. Although the ideas actually go back to Karl Marx, and there are long passages in his book Capital, which describe the rise of the modern factory system, essentially as a function of supervision, the need for supervision. So the idea here is that you can use the market, but there are costs to using the market. What are some of these costs? Well, there is finding out who in the market is able to produce what you want. There's the problem of drawing up legal contracts in order to establish a relationship and supervising or enforcing those contracts. How do you know if somebody has violated it? And that brings up the trust cost, which economists call the principal-agent problem. In other words, the principal pays the agent for a service. So the principal might be a firm, the service might be a worker. I pay you to do something, but the person who gets that money for the service has different interests than the person who's paying the money, and that can lead to problems. So what the principal might do, is to set up an organization or a system to monitor and enforce their incentives, their purposes on the agent. And that's what a firm does in some sense. Specifically for workers in the case of Marx, but the same concept has also been used to describe supply chains or value chains, which we'll get to in a little bit. Now, this is a useful theory, and it does explain some things, but if you look at the literature on the make or buy decision, actually relatively little of it is about transaction costs. Specifically, if you look at the management literature that discusses whether or not you should outsource, most of it is not about transaction costs, it's about other things. And that brings in the third theory, and that's the entrepreneurial theory, for lack of a better name. There's no real name given to this theory. It takes different forms with different people. One version of the theory is psychological. It dates back to Frank Knight, an American economist of the 1920s especially. And the idea here is people differ about risk. Some people love to take risks. They like to gamble. They're risk takers. Most people are not risk takers. They want a safer life. And so firms exist so that risk takers can hire people who avoid risk, pay them a regular salary, and then all the risk of the enterprise is loaded onto the shoulders of the risk taker. Yeah, there's some of that, but research shows that that isn't actually a very good theory in most cases. And in fact, to be a worker is also very much to be a risk taker. In many cases, a greater risk taker than somebody who has large sums of money that they spread out over many investments. The second version of this is Schumpeter. Joseph Schumpeter was an economist who started out as a central banker in Austria, came to Harvard University, and developed a theory about firms essentially as armies that compete with each other to wage war and to defeat the competition. And they do this through innovation to change the market. It's typically not incremental, he says. It's really creative destruction, to use his term. And there's some truth to this. A lot of the management literature reads in this way. I don't know how many managers have read Sun Tzu's Art of War, but I suspect quite a few. Nevertheless, that said, this explains only a very tiny proportion of what we see in terms of the make or buy decision. The final argument comes from strategic management theory. And the reason a firm exists, according to this view, is that there are many activities that would not be undertaken unless they were undertaken simultaneously together as part of a coordinated plan. That is, individually, it doesn't make sense to sit down with the client and get the information unless that's coordinated with doing the research, unless that's coordinated with preparing the legal briefs, and so on. The idea is that there are certain clusters of activities that simply have to occur together because you wouldn't be able to buy them in the market. People would not produce them unless there were a coordinated plan. Now, in terms of outsourcing, what that suggests is that if you outsource, it means there are certain things you're not able to plan anymore. So outsourcing then, from a strategic management point of view, becomes a conflict between, on the one hand, the desire to buy cheaply from the market, versus, on the other hand, the idea to have some kind of control over the activity that enables you to incorporate it into a coordinated plan. This is a theory which, for the most part, only exists in management. It's probably the dominant theory in the management world. Very few economists even know this theory exists, but I suspect as they eventually learn about it, it will become an important theory in economics. So, with that in mind, what can we say about corporate capitalism? What's different about corporate capitalism? Well, once upon a time, let's say the 19th century, if we looked at capitalism, there were basically owners, capitalists, and workers. There were a few other people, but those were the main groups. And the owners were the ones who made the key decisions in the corporation about what the corporation produced and how much workers would be paid and all those types of things, how the work was organized. But today, in a corporate world, a very large percentage of the workforce, a third, maybe more than a third, are managers. And they are the ones who, on a day-to-day basis, control the corporation and not the owners. The owners have very, as I said, attenuated control over the corporation. It's the management structure for the largest part that does this. And therefore, insofar as much of many of the coordination of the economy, those arrows that you saw in that previous diagram, are within the firm, within large corporations, and not between them. It's the organizational hierarchy of the firm that coordinates the economy in place of the market. So one way to think about that is imagine, if you will, that the government took over ownership of all the large corporations in the country. That would certainly have a big impact, but it's not even clear whether that would deal with the questions a lot of people have about how corporate capitalism works, because the government managers sitting in Washington, D.C. might actually have very little ability to control the operations of a very large multinational company with 100,000 employees around the world and so on. So it's important to understand how firms work in some detail and not just to say, oh, it's a business, and leave it at that. As I mentioned at the beginning, we have a world in which large corporations have come to dominate, but they exist side by side with a world of small competitive firms. This is referred to by theorists as the dual economy problem. So in the dual economy, and this is obviously a simplification because it's not just two little boxes, there's many boxes and many gradations of boxes, but the simplest version is that there are two boxes. In one box, we have the primary sector, and the other, we have the secondary sector. The primary sector is large corporations, secondary sector, small firms with maybe no more than a few dozen employees, if that. In general, it's true that the large firms in our country have, and in the world, make the highest profits, whereas the small firms scramble after very small profits and have a very high turnover rate, where many of them go out of business every year. Wages are higher in the large firms than they are in the small ones. And also the large firms have more access to capital, so they have more more and newer and bigger machinery and equipment and all the things money can buy. Small firms are more seat of the pants and labor dependent in their operations. Large firms are often very complexly organized, with huge internal systems of rules and regulations, and small firms typically are informal, based on face-to-face interactions between people. Quite controversially, but I think, again, it's a generality true, is that when you look at particular areas of environmental and health and other related costs, typically those costs are less on a unit basis in large firms than in small firms. So for instance, large firms pollute less in general as a share of their value added than small firms do. And it's not because small business owners are bad people, but just because they have less capital. They can't afford the kinds of technologies that are necessary in order to compete, but to reduce pollution. Similarly, most work injuries, or a higher proportion of work injuries, are in small firms. You could go on through the list. So it's because of the very competitive nature of the small firm sector that a lot of the big social problems arise of low wages, lack of health care, poor working conditions, environmental conditions, and so on in the small firm sector. And what to do about that is a big social issue. Two big events in the world of corporate capitalism. The first is production networks. It used to be, once upon a time, that if you wanted to coordinate work, you had to see the work being done. You had to be there. That's not true anymore with the development of digital technology. Now you can have very precise specifications for the different stages in production. And with the communication, the large bandwidth communication we now have, it's easier to coordinate geographically and organizationally dispersed activities. And that has meant that production has been modularized. That is, it's been separated into little segments, which can be located in different places, done by different people, and then brought together electronically in order to create a composite product. This is fundamental to why globalization has taken the form it has. In other words, it's the basis for global value chains. The second thing is financialization, which is that the latest stage of managerial and corporate philosophy and analysis has come to see a corporation as simply a collection of assets. Just like an individual investor might have a bunch of assets, shares of this stock or that stock or bonds or some other valuable pieces of paper, now a firm is seen as simply an assortment of valuable assets. And so, just as you have a stock market and a bond market where people trade their assets in order to go after the highest rate of return, now you have the reorganization of firms. Firms are buying off and selling, or selling off and buying different pieces of each other to recombine themselves continuously and in order to put together a portfolio which is seen as having desirable financial aspects. And if any one of the aspects of this portfolio, any particular unit of a firm, falls below, if its market value falls below what you could get by selling it off and liquidating it, that's what you do. You just liquidate it. And as a result, there's no long-term commitment to any portion of a firm, much less its workforce. So the final thought I'd like to end with is that many of the critical issues that we face in this world are exacerbated or at least transformed by the kinds of changes we're seeing in corporations. The shareholder revolution, the development of modular production and production networks, and the development of financialization.